Good morning, traders. The morning after the evening before. And what an evening we had. We write Thursday, the 3rd of April, and we are the day after the famous Liberation Day. I'm back after a few weeks off, and what a day to be back. There's so much happening all around. The world is seemingly in a new phase due to all those American tariffs. So we will have obviously a very close look at what's going on in the world of finance. Now we know what a Trump is wanting to do with all of it, and where those tariffs actually come from, because that is a story on its on its own. But before we get to the big part of what needs to be discussed today, let's have a quick look at what's going on elsewhere, because obviously, this being the main event that we were all waiting for this week, there's other things as well going on. So we will have a quick look at what's going on around the world. And first of all, obviously, geopolitics are still on the forefront. It's not all about tariffs in this world, and unfortunately, what's going on in the Middle East and surrounding Ukraine. There seems to be some things that happened while I was off, but everything is still not rosy. We can safely call this Middle Eastern ceasefire just a bit of a concept, but not really been applied on the ground. And we have seen between Iran, between Israel and other countries, the rockets are still flying. So there is something that we still need to keep an eye on, especially if we look at, in parts at least, if we look at what's happening in the world of metals, in the world of oil as well. That is still something that we need to pay attention to on the Ukraine situation. There's also some potential news coming, as one of the closest Putin advisors is expected to visit Washington, D.C. this week. So they may discuss about things. He's actually, if I'm not mistaken, an economic also advisor, or a wealth advisor also. So there's a lot going to be discussed about the money side of things there with him going over to Washington. So that's one thing that we're looking at. On the other hand, as well, we have a 2 days NATO meeting starting today, if I'm correct, back in Brussels. So they also are going to discuss about what's happening and what could potentially happen with Ukraine, as obviously has been already said, I trust, over several meetings and over our several shows. I mean, they are discussing certain plans where they would not be part of NATO, but still could fall under the umbrella for what defense is concerned. Um, Also, the Europeans are not really having a lot of confidence in what Putin is doing right now. And the Finnish defense minister came up today saying that Russia may be a threat to Europe within the next 3 to 5 years. So that is still ongoing, besides everything else, what I've been mentioning already. Um, on less geopolitics, but then local politics, or local, yeah, you can call it politics or local economies. In Japan, we had the largest trade union, the Rengo Group, come out with the third round data, which showed the average wage hike for fiscal 2025 could be now expected at around 5.42%, which is pretty good. Second round negotiations were coming out at around 5.4, so there's not too much of a difference. But the positive here is that we are still well above that 4.5-5% mark in the Japanese wage negotiations, would help the Bank of Japan to continue hike rates. Obviously, taking into account what's happened over those tariffs, which we will have a look at in a few minutes. Um, in closer to home, and that is then in the UK. There's been a bit of less positive news. We wouldn't notice it if we if we would only look at the cable today. But the less positive news lies in businesses. There's, I think, last month some 3,200 businesses who filed for insolvency and bankruptcy before, or trying to do so at least before the national insurance hike comes into effect, and where Chancellor Reeves is expected to announce less optimistic things coming further down the year. They also did it before the minimum wage increases come into effect and the capital gains tax is hiked. So a little bit of less positive news out of the UK business sector right now. Now, okay, let's have a quick look at the data that came out first of all. Yesterday's data, not a lot in there. I'm just looking through with you because as I'm just back, it's still a bit suffering from from jet lag. I'm still catching up on a lot of things, but let's run through a quick few numbers here. Yesterday we had that ADP coming out better than expected. We still saw that the service sector was hiring, but that could still be some front running of the potential tariffs. And also, while those numbers were taken off, there were still some enough uncertainties for those tariffs maybe not to be as harsh as they were in the end. And we are seeing the same if we move over to today. We are seeing the same in those European service numbers who were a little better. Well, Italy came down a little bit, but still comfortably above the 50 line, which is the expansion or contraction line. French, German, European PMIs for March, and again, I'm repeating, this is for March. Those data have been taken between the 12th and the 26th of March, so well before the tariff announcements. Those numbers were actually revised higher than what the flash numbers were. That also, I think, comes on the back of those announced big expansionary and fiscal measures that Germany came up with and that the European Union is also coming up with. So those numbers, take them with a fair pinch of salt, because next month, now we know what those tariffs comprise. Those numbers could be showing a completely different picture. The UK numbers came in slightly weaker than expectations, but still beating last month's numbers, I should say. Okay, so these numbers, nothing dramatic there. I do think that they kind of helped a little bit what we are seeing today on the global dollar front, but obviously they are not the major driver behind what we have seen today. Obviously. Elsewhere, not too much. Aussie numbers pretty decent as well. The Aussie is one that I'm going to look at a bit later, because there's a bit of different forces pushing and pulling there in the Australian dollar, and we will see the impact in various pairs on the Australian dollar. But for what the data are concerned, nothing really to get overly worried about. And now, without further delay, what did the orange hurricane come up with yesterday evening? Now, he slapped tariffs on absolutely everybody. So we see here that there is, and we can see it, for instance, if you look at the UK numbers, Brazil numbers, for instance, Chile, Australia, he slapped a blanket 10% tariffs on all imports from everywhere into the US. So the first one where we can start. So that's the 10% blanket. Some countries will be saying, okay, that was coming, that was the risk, but others, they will have thought that they may be completely out of the scope for those tariffs, but that is not the case. So basically, they slap tariffs on absolutely everybody. So that is the first thing. Then on top of that, Stephen, did they really get? I actually maybe I missed that, but Stephen is saying North Korea and Russia were spared. Yeah, go figure that one. But then we had those additional tariffs that he slapped on to several countries. So starting with China, okay? So he slapped a 34% reciprocal tariff onto China, which has been already well enough documented. I trust you will have seen that. That comes on top of the 22 or so percent that are already in place. So China is effectively going to be tariffed somewhere between 54, 56 or so percent in total. So that is the one thing. And if you look at Asia in particular, Asia got hit very hard. So China, Vietnam, Taiwan, for instance, even Japan got slapped a 24% tariff on there. India, and you name them, South Korea. They're all the Asian countries have been slapped with bigger tariffs than the global average, I will say. And one of note here as well, and I will have a quick look at the South African rand if I have the time today, because that one is also under the cosh for different reasons as well, because they have problems there politically as well. But South Africa, in line with really what the Asian countries were slapped onto, got also slapped with a 30% tariffs. Now, before I move further into what this means and what going forward we could see, just note at those tariffs, and there's been something really funny because they are um, not really representative of what um, the countries actually tariff the US, but they are based really on the differential in trade numbers between imports and exports. What the US has as a trade relation with those countries, and not really because if you look at it, for instance, here the European Union is not slapping 39% tariffs on everything that comes out of the US, but there is a differential in trade balance, and that is where the US based itself on to slap those reciprocal tariffs on. So, I mean, this tariff and reciprocal um, term is we could argue even completely false. Now, what's been the reaction? So first of all, let's talk about the reaction from other countries, other blocs, and then we will look at with the charts, we will look at what the actual outcome is. So first of all, we can imagine all those who have been tariffed solidly are all but happy. So China is really putting a lot of pressure for the US tariffs to be, well, fully and plainly cancelled. So that's the first thing. But so far, we didn't have any US reaction. There is still a potential for negotiation on all those tariffs because that is the door that the US left open, that President Trump left open to all of them, saying that if they behave nicely, we can discuss about those tariffs going forward. But the the numbers that are here are pretty harsh for some of those countries. So I would say that if the US doesn't really quickly sit around the table with the counterparts, we could have some real retaliations coming. So the Chinese, for one, are thinking about retaliations. European Union, we heard mostly all of them come out with retaliatory rhetoric. And actually, it was interesting what France was saying is that countermeasures could be coming to effect somewhere around half April. So they give themselves about a week and a half, small 2 weeks time to put those measures into place, which perhaps gives a small window for negotiation, but there would be a first set of countermeasures coming into effect half April, and a second one end of April. So, okay, these are potential retaliations that we will see. Now, I haven't really heard about the smaller blocks in Asia when they will think about. Oh, are you guys still with me? Because somebody is telling me that he lost connection to the flow show. Okay, all right. Okay, so most are still with me. Somebody on the chat was saying that he lost connection, so maybe Stephen is needing just to reconnect. So back to what I was saying. So we will have to see what kind of retaliationary measures will be put in place. But when it's like European Union concerned, it's probably going to have to do with American cars, with American high tech. The tech sector could be on the top of the list for retaliatory measures by the European Union towards the US. Okay. Um, Japan wasn't really happy either. The Japanese trade minister and commerce officials said that he didn't hear, or that Japan did not hear any rationale behind the US tariffs on Japan. But this is kind of where we can say this is putting into place against Japan what the global auto tariffs will be because they have entered into force today. So auto parts, all cars imports into the US will now be taxed 25%. We also heard that the de minimis rule has also been abandoned. So even smaller imports, uh, especially from China, we can say then that rule has also been abolished. So they will have to pay tariffs on absolutely everything. But yeah, the big block still the cars and auto parts tariffs are going to be enforced from today. Um, and so that is going to have a bit of an impact on Japan as well. We've seen, and I will look at the rates later. We have seen a bit of a yo-yo there on the Japanese yen, but right now the Japanese yen is really benefiting from really risk off. We can say and that outlook perhaps on the wages. But anyway, these are we are now uh, in the window where everybody is going to look at how they can retaliate against those US tariffs. Now, on those retaliations, that will, in my opinion, decide upon how quickly Trump and his administration could decide on going to sit around a negotiation table. So we are now in the first window, which is the retaliation, the expectations also, what it means for the US economy, because we have clearly seen now that the market is taking this as negative. First, um, the first impression of the market is going to be very negative on growth for the US economy. And especially, we know that US, just to name the US car makers, for instance, they import a very big amount of auto parts from elsewhere, coming through Mexico or directly from other countries. So the market is now in the mood of saying like, okay, this is going to be very negative for US growth in a first instance. If also other blocks start to uh, league again with each other against the US, is going to be ending up to be very negative growth in the US. So tariffs have two implications: the potential for a big inflation spike if they remain in place, and weighing on US and global growth. In this instance, since the US was a bit of an outperformer, as we have seen over the past years, this can now actually be undone because there may be an issue coming with the supply of all those goods into the US. Some countries may scale down on the supply. They may also sell less into the US. So that means that there may be a supply chain issue coming in the US. On the other hand, if all US companies need to pay those tariffs on let's say the raw materials on other parts, for instance, that is going to have a big effect on costs. We also know that the wages in the US are already higher, so that is going to have a direct impact on US companies, on their potential for spending, because they may spend less because they have to pay already higher tariffs. And so the market is now in this uh, window, as I said, about this is going to be bad for the US growth. And that is now what we're seeing in the market. Now, are we at the end of it? Not at all. Okay, not at all. We have been talking about it many, many times. There is still a lot of moving parts in here, especially if the US decides that they are getting enough warnings from their local CEOs. If take, for instance, the tech companies get slapped in Europe, in perhaps other parts of the world, like in some Asian countries especially, they may scramble back. That is a very big possibility, in my opinion, as well. So we are not at the end of this whole story, okay? This is what we have now. This is what we see now. The impact of what if all those tariffs remain in place? What does it mean for the US growth and for the global growth? Obviously, it weighs on global growth. And I've had many questions by people saying, like, yes, but if it weighs on global growth, usually the dollar gets a lift. But this is different, okay? This is a direct and I would say this is a direct attack on global on US growth in particular. And we have seen that all US assets have suffered. Okay, the equity markets are coming down. US corporates are getting sold off. The Nasdaq is getting is getting sold off as well, because there is a risk of tariffs onto or other measures onto the US technical companies, and they really are a major force in the tech world around the globe. So this is where we are now, okay? But we are still not completely done with everything, because also Trump himself said yesterday, oh, if people behave nicely, read come sit around the table, or perhaps reduce tariffs on US goods, they may also reduce tariffs on the countries that they have slapped tariffs onto, which and that's potentially in a second wave, which would then actually see a reversal of the moves, some moves in risk markets, at least, that we see now. And I'm going to go straight away to yields as well, because that is the impact of tariffs on the expectations for growth. And there, even though this is global growth, these are the German rates, but the US rates have been coming off quite sharply, okay? We have also seen, and I'm going to take the 10 years because everybody's looking at the 10 years. Some are looking at this as a head and shoulder, which is a potential, and we are breaking below the neckline. This 413, 412 was a big level on the US 10s, but this is the impact that the market expects on growth, further down the line. If there is risk for the US economy, and we have already starting to see revisions of banks and other analysts, revisions that US growth may get a real big slap. This is the impact of this. So that means that US yields are coming off as well, together with equities, and that is a negative for the dollar, to come back on what people were asking me. Yes, but if we see risk off, we usually see the dollar actually gaining versus some currencies. But this is not the case because we are now expecting uh, um, lower US growth. All right. So this is one of the reasons why the dollar is getting sold as well. If you see um, a simultaneous move down into yields and down in equity markets, especially in the US markets. This is the impact that we are seeing right now on the dollar, okay? Despite US slapping tariffs on other countries and it weighing on global growth. And it weighing on global growth, as I already showed, we've seen here moves on other currencies and other blocks, all the yields are coming down, okay? But since the US is the biggest block, that is where we see the biggest impact right now. I hope that is relatively clear. Bran, pop, pop, pop. So these different numbers are in addition to the tariffs we have already on them. Yes, they are in some. Like for instance, on China, they are in addition to what they already been paying as tariffs. Some other countries, and there we see on the Mexico and Canada, for instance, they still will have the fentanyl tariffs, but they will not be slapped with the additional tariffs because there are still those USMCA rules in play. So that is also why we see the Mexican peso and the Canadian dollar recovering also a little bit today because they are not immediately impacted by fresh tariffs. Um, Steven saying like you also read that Congress may step in and reverse his executive orders for tariffs. It would only take a couple of Republicans to switch sides. Yes, the thing is, we are going to have to see. Uh, I'm not calling it a rebellion, but we will have to see moaning about the biggest CEOs in America. Already, some have warned that things like this could weigh on their outlook, weigh on their results, weigh on their spending, weigh on the growth in the US. But we will need them to go to their Republican representatives and moan hard enough, and that may see a at least a partial reversal of the current tariffs. But that is going to come into let's say the next phase, and the next phase could be relatively soon, could be even before half April, but it could also drag on, and the longer it drags on, the more I think we will see the effect of expectations, money taking their chips off in the US. We could see a bit of a continuation before things get worse. Okay, we've heard Besson say that there is no Trump put, there is no base that they want in markets, but him being a long-term hedge fund guy, I think at some stage we will, if this unfolds into a US meltdown, let's say, we are not yet there, okay? Equity markets are coming off. Yes, they are coming off quite rapidly, but we are not yet, I would argue, in a meltdown, okay? We are not yet in a crisis period. I mean, to get a crisis period, we have to go back to what we saw. Well, basically, the best latest example was the pandemic, right? And well, it started already before, but then we had a pandemic. We're not yet there. We are in a volatile situation, but if you look at the volatility that we had over the course of the past years, we are not yet in a crisis situation. Okay, that would happen if we start to break below 385, 395 on the US tens. We may see that acceleration. And a lot of people now are talking about the expectations for the US 10-year, for instance, to get back to September 2024 levels, which is possible, very possible in my opinion, because I think this is just we coming from and you know, I've been those who listen to the various shows know that I also always said that to me the neutral was is around 420 somewhere around there right now, and then we will see how the economy evolves. So we are still not miles away from the neutral, although we are breaking some technical levels. But I think panic would not be, or bigger worries are going to pop up if we break below 385, 390 on the US 10s, but panic may install only if we get below 360, for instance. If we get below there, then that could install some more panic, and there you will see a lot of people getting out of the dollar. And I think it's a bit early to speak about something else. A bit early to say like the US is losing its reserve status, but if this trade war goes on for longer, there is a risk that certain blocs, name them the Europe, name them China, for instance, are going to be talking rather to each other than be talking to the US. So these are things that, if worse comes to worse, they could happen. Okay, and then you will see people, and you may actually paradoxically see the US yields pull up a little bit for a while if they get out of the US bonds. Um, but then in the other leg there you will see the real panic installing. But I think we are not there yet. Okay, there's still enough moving parts right now to say we could stabilize in between. Okay, I do think though that this leg is not done yet. I do think that we are going to see a test below 4% because there are enough worries about the US growth right now to continue to see this lower. For instance, on the 2 year, which is widely accepted as being a bit closer to what the Fed funds are doing and to what the Fed is expected to do, we are now seeing this move below this 385, 390 already on the 2 years, and probably we will have a move lower down to 350, 360, which is pricing in an extra cut from the Fed later on this year. Expectations for Fed cuts are now getting ramped up because we know, and then we come to to another leg and another uncertainty going forward, that if growth comes down too rapidly, central banks will react. And we are now starting to price in more cuts by central banks as well. But I think the Fed here, I've always been saying they would hate to have to raise rates on the back of higher inflation on tariffs also if we get into a trade war. But if growth comes down, on the other hand, they will, in my opinion, be more rapid to react. Perhaps stop the balance sheet. Perhaps, who knows, even increase the balance sheet again. But I think that would have been actually a measure that they would have used, that is buying bonds to combat the higher yields. So in this case, I think they would come out with rate cuts if growth really gets affected. That is really what I think where we are now. But again, we always have to think about the moving parts, because if what happens if everybody comes around the table, well, then you will see a reversal. But the reversal you may not see it. We will have jumps in yields, but I think the reversal would then rather be seen in stuff like, oops, sorry, in stuff like, oh, sorry about that. In stuff like, for instance, equity markets, okay? And I think that if we would see, and here you can see that I'm just back, and I had a bit of issues today as well with my trading view stuff. But here, for instance, you will see the bounce more pronounced in risk asset, pure risk asset, that is equity markets. Okay, because for now the market is getting rid of US equities. I still think that it can continue. The US Open today will be obviously extremely important. but we can see a continuation of this. And then we come back to a bit longer term levels. And if you look at the S&P, for instance, those longer term levels, to me, they come in at around 53 and a quarter to 53 and a half. That is the first. This is my red line here. I think that that is going to be a big zone as well. Okay. And the next one will be obviously if there is some more panic installing, and those things could happen simultaneously with what I showed on the yields, because that is a growth concern. Okay, that can happen simultaneously with yields if it breaks, and then we are talking about levels about between 4,900 and 4,800. Okay, this is going to be mega around here, because this is really long term. The long term recovery put into question if we would ever get down to 4,800 on the S&P. Can it happen? That'll depend on who, when, and what has been decided when people come sit around the table, if they come and sit around the table. Okay, and timing will tell us. Okay, that only time can tell us. Okay, but those are big levels. I also had have I got it here? Yeah, I've got the Nasdaq here. This is one that I pulled up a while ago, also before going on my break to see my little grandson in Japan. Nasdaq, as you can see, we've been trying and trying and trying, and since the end of March, we have seen this kind of move starting, on the dollar, on the US assets, because there was this risk. But now that we are below here, this 20K, we've also already broken below the 61.8 of the last move higher. This is only the move from middle of 2024, and don't forget that we are coming from much lower levels still. But so we are still undoing moves that took us to pretty lofty levels. But I do think we have to look at these on a slightly shorter term frame, because it's going to be important. I think if we get down to low 1800s on the Nasdaq, this is a bounce level. Okay, this is also a prior low from where we see a bounce, but there would be a risk if we get down below here that we revisit 17,000, low 17,000, and there it's going to be very important in my opinion as well, because this is a prior low just around 17,000 from where we had another leg higher, and here also we saw a bounce from 17,200. So this is going to be important in my opinion, and before or until possibly we get there, I still think that this is big money managing their money, getting out of certain US assets, and we're seeing it on currencies as well, getting out of the dollar, growth worries. But time will tell if we break below here. Can we break down before? Yes. I mean, tomorrow's Friday. Friday, everything can happen. I mean, imagine that we get a stupidly bad NFP report tomorrow. Those things can really accelerate lower. And also at the open, I think we are going to see a bit of continuation of what we are seeing right now. But until we break through those really big levels, I would say, like, be careful in time. All right, be careful in time. Right now, I don't see what is going to reverse it, unless Trump goes straight away. Oh yeah, the tariffs were just a joke, and we miscalculated everything. Something of the likes. Then you would see a risk rally again, and tech will be part of your risk rally, because they are at risk of seeing retaliatory measures slapped onto them as well by other blocks. So this is also one that we need to watch very, very carefully. Okay, so that for that. Now, whoops, what's been going on elsewhere? Let's first of all look at the euro dollar, because this is interesting here right now, because we are already at that 110.5, which is a bit of a trend line here coming down. that I noted also a while back, and I think Blake has already has also spoke about that 110.5 in our room at least, and I think I guess on the shows as well. We are already above there. It's really the dollar that is getting sold off, and the potential of retaliatory measures heavily weighing on U.S. expectations. This is we're getting into big zones, okay? First, this morning, we tagged the 71.8 of this move lower from September down to January, and now we are well above that, closing in on the 88.6, which is right around 111. But we are breaking this trend line here. Let me quickly um, try and go to a wider one because I wouldn't. Yeah, no, you see, I haven't really. Let me just. Oops, sorry about that, guys. I need to get rid of a couple of things here. Bear with me. Just trying to look at the wider picture here because we are getting really into very interesting zones here. Okay, so we've had in 2023 this bounce up to 112.75, which was the 61.8 of the big move lower from 123 in the euro dollar. That rejected. We came close to it in September, October. That rejected. And now we are trying to get back up there. And you can see on weekly patterns the price moves. We've always held back from managing to go higher. But what if we would break above here? I think there is a potential here for 115. Okay, I'm not saying it's going to happen today, but if the situation on the tariff front doesn't change, and if we see retaliations coming, really, there is, I think, a potential this time that we are going to see a weaker dollar and de facto a higher euro dollar. But we need to break those levels, okay? We need to break that 110.5. We need to break that 111 and a quarter or so that we saw before. We need to break 112. But if we break above this 112 quarter, 112 three quarters, I think 115 is could be really on the cards. And we are in a situation where we cannot exclude these things right now. Okay, if you would have asked me a month and a half ago, I would have said like buying euros, no way. But I've gradually been changing my opinion, and really, whoops, the euro is really flying right now as we speak. We're already trading above 111, people, okay? So this is important what's happening here, all right? Because this is the market telling us that there is an erosion of confidence in the US. Okay, so be careful with what's happening in the next, and I would say, and especially the next 1.5 day. From my point of view, that means the US Open later today and the Asian session and tomorrow Friday is going to be very, very important. We're actually really the dollar is getting dumped here, guys. Okay, we're trading already at 111.40. This is really going very, very hard. So keep a very, very close eye on what's going to happen in the 112s, okay? Because this is really going very hard right now. So we are now live also facing a bit of a confidence reset crisis. We will see, but a confidence reset in the US economy, and it's happening everywhere. So cable is not an exception. As I was noting this morning on my return, we are above 130, 130.5, and you can see that I've highlighted this zone as being quite important. We are through, and now we are on our way to retest those highs here in the 132, 132.5 zone. I'd say this is quite bullish, but we can also see euro sterling is ramping higher right now. So this is in the midst of um, of everything that's happening now on the dollar. The euro is also flying, and I'm actually looking at a bit of a headline because the Spain's Prime Minister Sanchez just right now said Euro needs to deploy a package of counter tariffs, and that is echoing what Germany has been saying, what France has been saying. So it seems that the European side is rallying together with each other and really putting the pressure on now, and that is mainly the reason why the euro is flying against virtually everything right now. Yeah. Um, so cable, I would say next level here, 132.40, 132.70, stretch it up to 133. That is going to be the next important zone here. But I'm especially interested that in what's happening with the euro here, because it's really the euro ramping higher versus everything. You look, for instance, at euro sterling, and that's just the euro sterling on our in our morning here. We started off a little lower, but now we are again threatening a breakout, really. Keep a close eye on what's happening at 84, the figure. We are trading above. This is that euro rampage here. I think a massive amount of stops are going through on all shorts euro as well. And we are back above 84, 84.05. So watch out. If it can hold, we're probably going to move back up to 85. But as we have seen so often in the prior months, it doesn't usually. Okay, so keep a close eye on what's happening at 84, the figure. But there's another one that we need to look at because dollar yen has also been sold off. It does slow down now because of this euro demand. But watch this dollar yen. And this is pretty important level here. 146.60, 146.70. We are below. There's still a number of tailwinds behind the yen. One of them is that those wages are still going the right way, but there's some other tailwinds as well. Okay, probably Japan still has a fair chance of seeing their tariffs reduced at some stage versus other countries because they still need Japan as a buffer, kind of a buffer in Asia. But also right now, and that is a risk. Risk is weighing on all things versus yen. Okay, so we need to be very careful here because we could see when the US walks in a bit of an acceleration. If in turn, and then I come back to what I said, people get around that negotiation table, then we need to be careful for the other side in the end, all right? Because if risk rebounds at some stage, looking at the volatile nature of the yen, this could easily get back up to 148.5, 149. Why not? But for the time being, watch this zone here, 146.5, 146.60 up to 147, very, very closely on the day, because we are in the process of really testing it very hard, okay? So that for the yen side. There's a couple more that I would like to look at, even if things are moving quite fiercely. But one interesting one here, very interesting one in my opinion, was the Aussie one. The Aussie got slapped, hammered in the first round of the tariff announcements because, first of all, it was part of the blanket announcement, but secondly, and mainly because also China got hammered pretty hard. So the people are still making the correlation between what's happening in Australia and what's happening in China. But interestingly enough, where the dollar China holds up right now, Aussie bounced from that 62.20-25 zone. Okay, so we are still in this triangle right now and is now on the way back up, already at 63.5, following the euro from the distance. Yes, the Aussie dollar is not benefiting as much because we see euro Aussie, for instance, ramping higher because Aussie is somewhere also a risk currency. But I would zoom out a little bit and just say that overall, to me, the Aussie is not really a strong currency as of yet. We're seeing also Euro, Aussie Kiwi coming down. And in all of this, where if the Aussie would have been strong, we would already have been trading 63.80, 64. Can we trade it? Oh, of course we can, because if people continue to sell dollars, we can go up to 63.80, 64 the figure. But I would still say that in this global picture here, we will need to break above 64 figure 15 for a trend to start to develop in the Aussie. And that is a level, and I wanted to have a look at the Aussie, that is very, very, very important to me. Okay, I think this is really a very important level on the Aussie, and we need to get above for the Aussie to gather more strength, right? Okay, yeah, and then I'm because I'm looking at the time as well. I know it's very important what's going on, but let's look at gold. Gold, and I've been saying it since the start of the year. Gold was one of my main plays of the year. That gold is a hedge against everything that can go wrong, and I think we have seen the effect that we had on the tariff announcement again yesterday. We have seen it in the run up to the tariff announcements as well, that Asia has still been buying gold. Now we need to be careful on the price. I think there is no reason for it to reverse, but there's been a lot being bought already, and I would argue that we are coming into a very important zone. At the start of the year, I didn't know exactly where gold would end up. I really thought that it would have been one of the plays of 2025. It's actually going a lot faster than I think. And it went a lot faster than I think. I thought 3,000 would have been seen, perhaps above. We are well above now. Asians getting slapped with a lot of tariffs, so they, as a hedge, buy gold. Interest rates are coming down. As a hedge, you can buy gold. Growth risks are really coming down. As a hedge, you can buy gold. So again, I repeat, it's a hedge against everything that can go wrong, and it has been your perfect hedge so far. Okay, I mean, if you look at it, we started 2025 end of December here. We started at 2600. We are trading 3100. Okay, so this is really a really, really good place still. Can it come down? Well, how much more do you want to hedge is now my question. So for me, I'm not going to chase it here. Okay, it can hold up and we can go higher, but I would say that 3200 or anywhere between 31.5 and 3200 is a very big level to me. I think we need to go back to watching Asian sessions. Okay, if they continue to buy, then gold is probably not going to come down. But if those hedges are sort of done right now, then I think there's a little bit of a risk, and especially there will be a big risk if people go and sit around the negotiation table, or if we see all of a sudden a reversal in those tariffs and lesser tariffs being applied, or even some being abandoned. So be careful here. This is the only thing that I'm going to say. Be careful here, okay? I think the big support right now is right around 3,000, but I would not exclude that if all hedges are done, we are going to see a bit of a move back down, just to relieve the pressure a little bit. But if in time those tariff pressures, those lower growth expectations, they would come to fruition, the lower growth expectations, gold is still going to be your hedge, okay? And then we can actually move even higher. But I think for now, we will need to be just that little bit careful. I'm not saying this move is finished, because it's still part of my play for 2025, although time has accelerated a lot in of those plays. But here, be a little bit careful where we are, Derish. And with that, guys, I know that I told you that I was going to look at other stuff, but I'm looking at the time, so I will talk about the other things perhaps on Face also. But for this session, we are going to call it a day. Thank you all for being with me. I hope that I have helped you a little bit in everything that's going on, especially from the fundamental side, what's going on with those tariffs, what the possibilities are. So thank you very much for being with me. And tomorrow, NFP day, okay? So we will be back together tomorrow. Have a good day, guys.